All right, so this next section is about the tactics of a millionaire trader. Now, it's very important to have an understanding of what you're potentially looking for throughout the trading day, right? With a margin account, you're looking to do mainly quick scalps. And what quick scalps usually are is potentially getting into a trade and trading maybe a setup of maybe a minute, 2 minutes, right? 5 minutes. I would say usually a max of maybe 30 minutes in a trade, right? Now, the reason as to why this is because you're looking to maximize on your profits, right? Now, the way you can maximize on your profits is you can actually have a larger position size. Now, the reason as to why you have a larger position size is because when you get into a trade and you are looking to make profits, if you have a larger position size, you're actually going to be able to make much more money during the course of that day. Now, for me, I trade with SPX, and what SPX is the index for the S&P 500, right? If you're a trader, you know exactly what the S&P 500 is. I trade mainly SPX, and that's specifically because it's the most liquid index in the entire stock market, right? So if it's going the right way, it's going the right way fast. If it's going the wrong way, obviously it's going to be going the wrong way fast. But like I said before, you have to be quick to take losses. Take quick losses, take small losses, because again, because you have a margin account, you're going to be able to get into a trade the very next setup that you're potentially looking to get into, okay? Now, with a larger position size, you don't need to stay into a trade for too long, right? Let me give you an example. Let's say you put in $1,000 on a trade, right? In order for you to make $500 on that 1,000, you're going to have to wait for a 50% gain on your trade. Now, because options is really just a game of multiplication, right? In order for you to simplify this process, maybe you put in or you risk a little bit more money, right? So that you can get that same result of $500 on that trade. However, without having to spend so much time on that trade, okay? Now, I'm going to explain how to increase position size in a second, but follow me on this example here. The same trade of taking $1,000 and making 500 on it to get 50%, right? What if you took 10,000 and maximized it by only having a 5% trade? Okay? You took 10,000 and made 5% on 10,000. That's $500. Now, you can find 5% plays all day long. Like, you can literally find 5% trades all day long. The whole idea of it is to say, hey, even though this is a heavier risk amount, I don't have to stay in the trade as long to still get the same result. Does that make sense? Right? So $1,000, to take $1,000 into a $500 gain, you have to wait to make 50%. It's not too easy to make 50% on plays in the stock market, right? But you can find 5% plays a lot of the time, right? You risk 10%, knowing your setup though. You risk 10,000, sorry, not 10%. You risk 10,000 on that play, and you're in the play maybe for about 2 to 3 minutes, right? You end up going up 5%. Voila, that's $500. You can close your laptop and go about your day. That's the end of your trading day at that point, right? So having a larger position size at that point allows you to be able to then be a lot stingier, right? A lot quicker with profit taking, right? So the way in which you get to a point where you increase your position size is by scaling in. Now, what scaling in means is that you are getting into the play essentially maybe 1 or 2 contracts at a time, right? You're waiting for your setup to happen, and it's going in your it hasn't gone fully in your direction just yet. So you're buying a few contracts at a time. Once it goes your direction, it would potentially go direction quickly, and then that's when you would take profit, right? Take profit, put it in your account, sell your contracts, and get out of there, right? This is even if you're buying calls or puts, either direction, right? So you see a setup potentially. Maybe you're looking at an ascending triangle, right? It's still respecting a specific trend line, right? So let's say you're banking on the stock going to the downside, right? Now, an ascending triangle is doing this. It's squeezing and then eventually it just goes down, right? And then the descending triangle is obviously the inverse way. But let's say you're trading puts potentially, right? The triangle is still is squeezing, right? It's coming down to squeezing, and then eventually it falls. Okay. Now, as it's squeezing, maybe you buy a contract up here, right? And then it comes down a bit, but then it pops back up, but still respects the trend line, right? You would potentially buy another contract up here. If you buy a put contract, while the momentum is not all the way coming down, you would have a cheaper contract at that point. So you buy a contract up here, it comes down a bit. It hasn't broken the level just yet, but then you buy it right here. It hasn't broken just yet. You buy it right here, and then all of a sudden it falls, right? Now, if you're, like I said, you're buying put contracts, so you're betting on the downside. After you've bought 1, 2, 3 contracts, you can imagine, the amount of profit that you're taking at that point. From there, you just kind of set a sell at market or a limit order, whatever it is, take your profit. You're done for the day, right? Now, the best part about this strategy as far as scaling in is that if whatever reason, because this is the stock market, everything is unpredictable. For whatever reason, if we're seeing that it's an ascending triangle, but then it goes to the upside, then your losses are minimal because you're not buying at the low. You're buying at the high you're not buying the low of the chart, at least. You're buying the low of the contract up here, but not the low of the chart, right? So you're buying as it's looking like it's going up, but it's still stopping at this trend line coming down, okay? So you buy here, it comes down a little bit, it didn't break. You buy here, it comes down a little bit, it didn't break. You buy here, and then it falls, okay? If you buy here, let's say it goes against you. You buy here, it goes down a bit. You buy here, it goes down a bit, and then it shoots up. This is your stop loss right here. This would be your stop loss. So your losses are actually minimal at this point because you were cognizant of the fact that you're only taking contracts at the trend line. Now, the inverse, if you took contracts at the lower of the chart, right, betting on puts, and then it just pops up on you, your losses would be a little bit more than if you took put contracts at the higher end of the trend line. Okay, I hope that makes sense. As far as the idea of position sizing as well as entries, because what I just talked about is entries, right? You get in, you enter in at this point, you enter in here, you enter in here on a triangle, right? This is your triangle. You enter here, you enter here. By the time the triangle comes below, you start falling. That's all your money right there, right? Now, if this is the triangle and it breaks the triangle, then because you were positioning at the high of the chart but low of the contract, right? Because if you're in a put contract, this point right here, the contract is pretty cheap, right? But the contract gets more expensive as it comes down here. So you don't want to buy down here because right here, the put contracts are a little bit more expensive. But if you buy it up here, it's least expensive. It's coming down, you take profit. If it goes up, your stop loss takes you out and your losses are very minimal at that point, right? I hope that makes sense. Let me know if you have questions on that, and then we're gonna go ahead and get into the next section here.